We're coming off two years in a row of 20% gains. People are starting to get overconfident that this is what markets do. They just go up. They don't, a lot of people don't understand why. They don't understand that the prices of the stocks are going up more than the earnings, more than the sales, the increasing valuations. They just know it goes up. And this isn't just retail investors. Institutional investors are kind of giddy as well. And we see it in all of Wall Street's outlooks. And you watch CNBC for an hour and you'll see plenty of bullish forecasts despite lots of things we should be worried about.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week for another weekly market recap, this time featuring my good friend, the Unsinkable, Michael Lebowitz. Michael, how you doing?
I'm doing great. Thanks for having me on, Adam. It's nice to
All right. Well,
replace
look,
Lance.
Michael, yeah, folks have been asking me when I was going to kick Lance out of the chair and bring you in, and serendipity inserted itself. Lance had to be somewhere else today, and you were kind enough to step up on not too much notice. So thank you for doing that.
Always.
So I'd like to say this is the smarter, better looking side of the portfolio management team there at RIA.
And younger.
Yeah, okay, good. Good. Lance is, I'm sure, grinding his teeth to a fine powder at the moment. All right. Well, look, I started this with the term unsinkable for you because I wrote that before we got on here, Michael, before the jobs report came out today, which is markets have sold off a little bit based on that. But really, I think the term still stands. The market buoyancy has been pretty impressive when you consider that over the past couple of weeks, it's had a couple like near black swans come out of the woodworks. I mean, certainly DeepSeek was pretty close to a black swan. Maybe not so much the tariffs and the trade wars, because that was something Trump had talked about that he might do. But it definitely caught people by surprise last weekend when they announced the 25% tariffs on Canada and Mexico, and then the 10% tariffs on China. And what's been amazing is how quickly the market sort of shrugged both of those things off. Now we've also had most of the earnings for the Magnificent Seven, which I would kind of call mixed. It wasn't the usual blowout earnings session across the board for all of them that folks are used to. Again, market doesn't really seem to care. In fact, I'll pull up a chart of this in a second here. But retail sentiment is at an all-time high. In fact, there's a quote here from JP Morgan. According to JP Morgan, sentiment is even higher than it was at the peak of the meme mania in 2021. So let me just show this chart here so folks can see what I'm talking about. But basically, the market right now is sort of a Teflon market. No bad news seems to stick to it. Nothing is ruining the party vibe. So why don't we start here? Does this make you confident that, hey, this is a party that no one's going to stop, so everybody jump on board the party train? Or does this make you think that, hey, you know what, folks are maybe excessively optimistic here, and one of these curveballs that comes is finally going to catch the market by surprise?
Yeah. So first of all, you can never be confident about anything in the markets. But from that, I'm confident that that's a driver, a big, important driver of why the stock market has been so unsinkable. We know that sentiment is extreme. We know that there's a lot of optimism. We know that retail investors are pouring money into the market at the fastest pace ever. So while that's nice, that's good for today, it's keeping at a minimum, a floor on the market, not letting it go down too far when we have these sort of black swan events, bad events, or even like today. The reason we're down today is because Trump is talking about retaliatory tariffs, but the S&P is down 30, 40 points. And, it's not, which in the grand scheme of things is 0.5%, it's nothing. So this sentiment is really providing a nice floor to the market. Now we're coming out of earnings, so buybacks can start back up again. So there's optimism, and optimism and positive sentiment can win the day for a long time until, of course, it doesn't. And through my career and even going back before my career, this happens plenty of times. And we just, the market will figure out whether it's appropriately optimistic, whether it overbought into some of the optimism, and it'll play out as it will. And inevitably, it's likely there'll be an event, whether it's a black swan event or just something that's somewhat predictable, but not necessarily like tariffs, that may shake the market down and get us off these extreme valuations.
All right. Well, first let me just give a little bit more data too. So I've now think I've heard three explanations for today's market action. So you just mentioned more retaliatory tariffs. There was the latest payroll data just came out, which disappointed. Expectations were for 175,000 jobs to be created. Only about 143,000 were. But it was a real mixed bag. Like the unemployment rate, there were a ton of revisions. The unemployment rate actually went down from 4.1% to 4.0%. So you could point to some stuff that looked disappointed. You could point to some stuff that looked, encouraging. But some people are saying that that's the reason. Another reason people are saying the market might be down is on consumer sentiment. We just got some new data from University of Michigan. Definitely people's inflation expectations have jumped a lot. So I think that has maybe some of the market spooked a little bit too. But where I'm going with this, Michael, is look, you said there's optimism in the market and buybacks are starting up again. And no doubt, as Lance and I have talked about for many times over the years, the buyback window makes a big difference. You can attribute a ton of market performance to just buybacks alone. But buybacks themselves aren't anything new, right? That cycle has been going on for a long time now. I'm sure there are reasons that we can make to be optimistic about 2025, beyond just the people that are like, okay, I like Trump better. He's got a pro-business agenda, and I'm going to be excited about that. But honestly, I feel like we can come up with an even longer list of things that are happening recently that we could put at risks to the market, right? Like big risks, like DeepSeek is a really big one, right? We just don't know what impact that's going to have on the AI complex, but you can make a pretty good argument that there's not going to be as much profit in that space as people were imagining 3 weeks ago before DeepSeek came out, right? Now we don't know, but that's just it's uncertainty, and uncertainty should be discounted a bit. The tariffs, they were academic. Maybe Trump's going to do it. We don't know how much is going. Now we've actually seen it. Sure, they've been paused for 30 days. They might get paused again. What other countries is he going to put them against? Maybe Mexico and Canada don't do everything he wants, and he ramps them back up. Like there's uncertainty there. So, we can talk about slowing GDP growth. I mean, there's just so many things going on that you and I think we could come up with a much longer list of reasons to be worried here than optimistic. I guess as a capital manager, does that worry you? Are you taking that into account at all in your allocation this year? Or are you like, look, we're just going to ride this train until it actually starts showing signs it wants to go off the rails, and then we'll start reacting?
So, this is one of the hardest parts with being a money manager, is that you have to, first of all, control your behavioral impulses. That's maybe the hardest thing to do. And like you said, Adam, I could give you some depressionary scenarios. I can give you some recessionary scenarios. I can just give you S&P down 50% scenarios and reasons for them. I could paint some bullish pictures as well. But at the end of the day, what drives prices on a minute to minute, hour to hour, even day to day basis is sentiment. We're coming off two years in a row of 20% gains. People are starting to get overconfident that this is what markets do. They just go up. A lot of people don't understand why. They don't understand that the prices of the stocks are going up more than the earnings, more than the sales, the increasing valuations. They just know it goes up. And this isn't just retail investors. Institutional investors are kind of giddy as well. And we see it in all of Wall Street's outlooks. And, you watch CNBC for for an hour, and you'll see plenty of bullish forecasts despite lots of things we should be worried about. So as a money manager, we can't just say, oh, we're going to take our money and just wait for this storm to hit, because that storm could hit. This could be 1997, and the market may still have another 50+% more to go. So what we do is we appreciate the bullish sentiment and some of the bullish cases. We understand thoroughly all those risky bearish cases, and we look for signs that some of them on either side are coming to fruition. At the same time, we're watching market technicals. That's a great gauge of sentiment. Are technicals getting stronger? Are they getting weaker? And we're thinking about, okay, if they're starting to weaken up, how do we de-risk the portfolio? We could sell, we can buy shorts, we can just rotate. We can sell like the NVIDIA and AMD technology type names, and we can buy Procter & Gamble, Clorox, those type of names. So, we're always evaluating the tools in our toolbox, our scenarios, both bullish and bearish, and what's going on in the world. And it's important that we don't overreact. So what was that, 2 Mondays ago when I keep wanting to say Deep Six like you, but it's DeepSeek.
Yeah, DeepSeek. Yeah.
I always have to stutter for a second to get the seek out. When DeepSeek came out on that Monday, I was sure we were going to get hammered. And at the end of the day, our portfolio was barely down. And part of that is because we didn't overreact. So it was down decently in the morning and it came back throughout the day to be barely down. We didn't overreact. We didn't just sell. We wanted to wait to better understand it, but better appreciate the market's reaction to it. How is that going to change sentiment? Will it change sentiment? Is this just a problem for NVIDIA and a few other stocks, or is this a problem for the whole market? So we were cautious. We didn't do anything, but we also have a well-diversified portfolio because probably 2/3 of our stocks were up, and a few of them were up 2 or 3, 4%. So, and bonds had done well. So, you can't overreact. You have to know what's going on, and I hate to say it, but you got to play it day by day and just adjust your portfolio on the run.
All right. So I think Lance has said this, and I'm curious if you share the same sentiment. He was like, look, this wasn't a humble brag, but he was like that the last 2 years have been relatively easy to be portfolio managers because it was a pretty strong tailwind. He thinks this year is going to be more volatile, and for a whole bunch of reasons that he and I have discussed, it's just going to be a more challenging year as a money manager, probably for, in many ways, the ways in which you just said, Michael, where it's like, the party's still going on, but you don't trust that the cops aren't going to come sometime soon, right? And so you're like, it's not time to pack up and quite leave the dance floor yet, but I don't just want to be partying like it's going to continue forever. I got to be more cautious. You're nodding as I'm saying this.
Right.
So anyways, I appreciate you underscoring for folks, the fact that this is like a market that requires a lot of vigilance, right? And I imagine from talking to Lance that this is where, I use a pilot analogy, this is where maybe it's less clear out the windshield. So you're relying a little bit more on your instrumentation, technical analysis, other indicators, probably a very big one that Lance talks about, a lot of credit spreads. Like those are things that are going to begin to tell you that things, might be getting a little ready for change, but as long as like credit spreads are, remain super flat, you're probably not going to get off the dance floor.
Right.
Am I accurate in all this?
Absolutely. And we also have the advantage of being able to trade whenever we want. If you told me I could only trade once a quarter, I would probably reduce a little bit of risk right now. But I can adjust on the fly and do it very efficiently. So that's absolutely right. We're concerned that this year is not going to be the last 2 years, where it's it can happen, but being up another 20% is very unlikely. What the tougher outlook is that we're going to be on a roller coaster ride to nowhere, that we end the year up or down a few percent, but during the course of the year we were up 10 or 15, down 10 or 15, and just oscillating back and forth. And that becomes, that's a very difficult environment because the market's not trending. We've been trending for a while. Trends are easy. And when you break those trends, but when you're just oscillating, that's a much more difficult trading environment.
Yeah, and I'm glad that you mentioned the timing of trades there, right? So as an active portfolio manager, you can buy and sell minute by minute if that's what you decide is the best thing to do, right?
Right.
Whereas the average person, who's got a job, family, all that stuff, they're much more of a, well, let me look at my statement, at the end of the week or the end of the month or the end of the quarter, right? And so I imagine in environments like this, it's particularly hard on the sort of the relatively passive retail investor who doesn't trade all that much because there's a lot of activity that happens between the time that they actually have the ability to focus and think about making decisions in their portfolio. Is that true?
Yeah, yeah. And look, you can be passive, and Warren Buffett has proven that's a great strategy. But if you're going to be passive, stick through it when the market goes down. Don't panic and sell at the lows. So, and if you're not going to be passive and you want to be active, you either pay attention, you hire a money manager that is paying attention, or, you reduce risk based on what you see for the next few months. So, there's plenty of options. You can go many different directions, but I think at the end of the day, understanding the risk reward ratio is not in your favor right now. Valuations are more or less at record highs, and that portends poor returns. Yeah, it can mean that we're down 50% this year and we go up 3% for the next, you know, 5% for the next 5 or 10 years. Or it means we're up another 20% for the next 2 years and then we dive 80% before we go up again. So they're not in your favor, but that doesn't mean the party's over. The police aren't knocking on the door yet, so to
Yeah,
speak.
yeah. Okay, well, look, Michael, maybe you can bring up, if it's easy for you, the chart of the S&P, just so we can look at technicals real quickly, just to give people a sense of the markets, short term, overbought, oversold, et cetera, where we are versus the daily moving averages. I'm also going to ask you in a bit about bonds, and I should have mentioned that earlier because I'm sure the second people saw your face on here, they were like, okay, so when's that? I'm going to ask Michael about bonds, folks. That's coming. Um, but while you're pulling it up, Michael, I just want to reiterate this because I made this comment in another video recently. I'm not sure if it's one that's released yet or not, but I think what's really important for the folks that are watching this video is just to know what type of investor you are and to be honest with yourself about that, especially given the type of environment that we're coming in right now. If you're a successful DIY investor who's got experience, investing in volatile markets, like it looks like we may be, having this year, great. Continue to do it yourself, right? Maybe the thing to invest in is additional information, right? Besides watching channels like this, maybe subscribe to a service like SimpleVisor. They're over at RIA, where you're getting, kind of Bloomberg-like data and analysis, and you can use that to inform your own trading style, right? If you are a DIY investor, you're just not ready to give up the reins yet to somebody else, but you don't have experience in markets like this. Well, then, there are professional services that you can subscribe to out there. Darius Dales is a great one. Lynn Alden's. I mean, other people who basically, are giving you their, ongoing. Okay, this is where I see opportunity. This is the portfolio allocation I recommend, and you can basically be trading over their shoulder, and then you can determine who you want to, which one of those people you want to follow. And again, you can be leveraging their expertise in these volatile markets as you try to trade them yourselves. And then, of course, the third is to say, look, this just isn't me. This isn't my area of expertise. Rather than trying to figure out the next stock to put in my portfolio, I should really focus on finding the right financial quarterback who can run all this for me. And I'll be the coach. I'll tell them, what my goals are, and they can come up with a, personalized plan for me, and they can run that ball for me because they've got all the experience. They're watching the market, daily. They can do the active trading in and out much more than I've got opportunity to do so. So, folks, if there's anything you take away from what I'm saying here, is just really spend some time thinking about, okay, what type of investor am I? Be honest with yourself. Which of those buckets do you fall in? And then use the appropriate strategy based on that. All right, Michael, thanks for waiting there. So I see you brought up the S&P here. What's it
The,
telling us?
this is the S&P. There's a lot going on here. So let's just start with the price which is in the middle. And you can see we've kind of been on that roller coaster. We really haven't gone anywhere, but we've just been going up and down, not really trending. But you can see the moving averages here, and in particular, the blue one and the darker orange one. And right now, we're still above those key 20-day and 50-day moving averages. And as long as we're above both of those, we can have some level of comfort. But also, that's a point where if we want to be overly cautious, we can start selling if we do dip below them. The 100-day is this lighter orange line, which comes in around 5,900, so about 150 points below where we're at. And ultimately, the 200-day is at 5650-ish. So that should be a much more firmer level of support. So that helps kind of guide us as to when we may want to start taking off risk, or also above certain levels, we can have some level of comfort. This is the MACD up top. And one concerning thing is that you can see that this peak, the most recent peak, is lower than the prior peak. That's a negative divergence. The price hit a new high here, yet the MACD didn't. So that's a reason for concern. Now, working against that is this lightish green. This is a money flow indicator. And what it's really doing is it takes, I think it goes 21 days, 23 days, 20 days. And it looks at each day and it says, what was the range for the day? What was the high and what was the low? Where did we close within that range? And multiply that number by the volume. So if you closed at the high end of a range, the 100% part of the range on very high volume, that day will give you a very positive, very strong reading. And conversely, if you close in the lower end of the range on high volume, it brings the reading down and it looks at the last 20 days doing that. So that's telling us that there's a lot of money flowing into this market, despite the fact that it's not really going anywhere. And then the RSI is not really helping us at all at the bottom. It's kind of right around in fair value territory. The tricky part with the MACD is it doesn't necessarily just oscillate up and down. That blue line could bounce off the orangish line and continue its upward trend. So we're getting mixed signals. Fancy way of saying we're getting mixed signals. There's reason to be cautious, reason to think about de-risking. There's nothing that tells us we need to think about selling half the portfolio or a quarter of the portfolio. But maybe around the edges, you should start thinking about, if we do want to sell, what would we do? What are the 2 or 3 stocks we'd want to sell? And conversely, we do similar analysis on the stocks we own, and we're contemplating buying a few stocks as well. So, how we ultimately would de-risk, which we're not doing necessarily, could be done again we could be buying and selling. We could be selling. There are many different ways to do it.
Okay. All right. But long story short here, market certainly doesn't seem oversold, but it doesn't seem dangerously overbought. We get a mixed bunch of signals here, like we said. So basically,
It seems confused. I think it's genuinely confused, just like we are, and just like most money managers are, that, there's a lot of bad headlines. There's a lot of optimism for what Trump's going to do. There's a lot of pessimism for what Trump's going to do. So there's just a lot of confusion. One of the ones you mentioned earlier, why was the market down today? You mentioned University of Michigan inflation expectations. The funny part with that is, and I have a graph here actually, because I tweeted it today. So what you see here is that this is inflation expectations by party. And you can see that when you go back over time, they trended the same way, but Republicans thought, prior to Trump being elected, thought their 1-year inflation expectation was much higher than Democrats. Well, look what happened with the election. They flipped on a dime. All of a sudden, Democrats are worried about inflation. Republicans think there's going to be zero inflation in the next year. So looking at inflation expectations, at least by the University of Michigan survey, is off right now. It's usually a decent indicator. It's just off because what we don't know is how many Democrats did they survey and how many Republicans. Are the Democrats carrying twice as much weight in the survey or vice versa? So again, it's confusing data. The unemployment report today was I could write you a great bullish story and I could write you a great bearish story. And that's a lot of the data and a lot of the news. And I think a lot of sentiment can be the same way. It's a very confusing time.
Okay, and so right now, again, just to bring it down to brass tacks, and I'm going to ask you about your trades, near the end of this discussion as normal. But kind of the vibe I'm getting from you is confusing time. We're kind of in wait and see mode right now. We don't see a lot of indicators that say we've got to do one thing or the other right now. So we're just kind of scenario planning so that if things go down, we kind of know what we'll sell. If things go up, obviously we know what we'll let ride. But really, you're kind of waiting to see if any sort of trend emerges from the current wishy-washiness.
Exactly. But I think what's important to understand is where's the exit? Know where the exit is, know how you can get there, and doesn't mean you're ever going to have to leave your seat. But and this holds true in all environments, but I think it's a little more so in this current environment, and especially with Donald Trump, who is seemingly issuing executive order after executive order. One of them could roil the markets. One of them could cause the markets to surge as well. So just, appreciate where that exit is, and if you need to get a little closer to it. But at this point, there's no reason to open that door yet.
Okay. So I want to ask you in a moment about, there are things that have been, there's structural things that have been kind of helping the market continue to rise, right? There's been liquidity, which we've talked about a ton recently. There's the giant mindless robot of passive capital inflows, largely coming from corporate retirement purchasing. There's been buybacks, as you mentioned in the S&P chart you showed that we're in kind of a net capital inflow in the markets. We've obviously had foreign capital coming in. But another factor that's been contributing has been sort of the evolution of the ETF space.
Mhm.
And I want to talk to you about that impact in just a second. There was one risk factor you mentioned, and I want to just scratch it just a tiny bit. So we talked a bit about today's jobs report, which you said, okay, we could make a bullish story out of, we can make a bearish story out of. For the past 2+ years, whenever the jobs reports come out, Lance and I would spend a lot of time trying to dissect it, but basically saying there's a lot about these jobs reports that just doesn't smell right. Right. We've talked about kind of the error that's in BLS right now, in some ways from how distorted all the data got during COVID and all that stuff. Certainly accusations of people out there of the last administration trying to make things look extra rosy coming into a presidential election year, all that type of stuff. But we're now, while this wasn't a barn burner payrolls report, it wasn't a terrible one either. But we're hearing more and more data out there that people are just saying, you know what? Jerome Powell is telling us that the jobs market is normalized, but it's still really good and it's all healthy, and this is kind of right where we want to see things being. But a lot of us are looking out there in the real world, and we're seeing that it's companies are laying off, there are hiring freezes in a lot of places, and even Powell, when pressed by the journalists at his latest press conference, like some of them really went after him on this. He said, "Well, it's a good jobs market if you got a job." He said, if you're looking for one, it's a little bit harder. And I don't have the headline here, but I saw one yesterday, I think, that said it's I guess harder than it's been in the past 3 years to get hired right now. And we've certainly seen the quits rate come down in the markets, which is a sign that workers have lost their bargaining power. We've seen hiring rates come down. So where I'm going with all this on the job side is even with the pumped up data that it looks like we've had over the past couple of years, we've definitely seen that, like, we've lost net on net full-time jobs, right? Part-time jobs have been really driving the growth. And private sector jobs have been in decline as well. Like the major hiring's been coming from the government sector, right? So now we've got Trump in there. We've got Doge, right? We've got this hiring freeze. We've got this, 2 million workers have just been issued a buyout plan. It does not seem that the government's going to be carrying the water that it has up until right now. Um, how worried are you about the employment situation changing, relatively quickly from here, and presumably changing for the negative based upon all these other things, unless you see opportunity of ferocious job creation over the rest of 2025?
No, no, I'm very worried. And I'm actually very glad that Powell pointed something out that we had been talking about. The hires rates have come way down. The job openings rates are way down. So the problem is, it's not necessarily people getting laid off, although that could become a problem with the government. It's a stagnant labor market. So if people start getting laid off, there are no jobs for them to go to, right? So my concern is that the unemployment rate could go from 4 to 4.2 to 4.6 to 4.8 in a blink of an eye to 5.8, 5.5, because people are getting laid off, but they're not finding jobs nearly as quickly as they have in the past. I think
Right.
that's the big risk.
And sorry to interrupt, but I mean, don't we? I mean, time will tell. But I mean, didn't we basically just have the government tell 2 million workers, we're kind of getting rid of you. You can take the generous buyout offer now, or you can roll the dice and see what happens. But like, if you look at USAID, right? Presumably that single organization itself just got gutted from what, 10,000 employees to 294 or whatever,
Right.
right? So I mean, who knows what the ultimate job cuts are going to be in government? But you're basically saying to the government, look, we're going into job shedding mode. So, I mean, just that alone could dump a lot of bodies into the unemployment, or into the employment world, right?
Yeah, I mean, that doesn't, it's a concern, especially for me living in the DC area, because I think overwhelmingly a lot of those people live here. But again, it will be a somewhat local to the Washington, D.C. area problem more than a national problem. And even if they let go of 100,000 people, say they fire 100,000 people today, right? They're not firing all 2 million or coming even close to that. But if they cut out 5%, that would be a big number. That's 100,000 people or so. That's the jobs number today was 143,000. So you get a number that's 43,000. It's not a good number, but
But
it
not negative yet. Yeah.
but no, positive 43. It's still positive.
That's what
The
I'm saying, not
unemployment,
negative. Yeah.
right? The unemployment rate may tick up. You're going to see jobless claims rise. To me, what matters more than anything is sentiment, consumer sentiment. Will they keep spending? Because we've seen a pretty resilient consumer, right? And I think the biggest thing that dictates that is the job market. Are you comfortable with your job? Do you think you're going to get a raise? Does the person that sits next to you, are they getting fired? Is your neighbor comfortable with his job? And when you start getting uncomfortable that you're either not going to get raises or that you could be fired or that your company's going to let go 5% of workforce, you spend a little less. Maybe you don't go out to a dinner or two. Those little cuts in consumption account for 70% of the consumption, personal consumptions, 2/3 or even more of the economy. So when people just start cutting out little things, maybe we'll just go on vacation for 4 days instead of 7. That can have a pretty big effect. So it's the labor market and sentiment of work of people that have jobs that really matter. And that's why things can steamroll pretty quickly if people are concerned they're going to lose jobs. And the government is a part of it, but I think it's much more the private sector. And if they start laying off, is going to be a much bigger problem.
Okay. So let me ask you this. You remember, war games with the nuclear threat level, DEFCON 5 through 1, right? DEFCON 1 is like, we think we're going into nuclear war imminently, right? What kind of DEFCON level would you put your personal perspective on the employment market in terms of your level of concern for it?
Kind of in the middle.
So 3. Okay.
Yeah, it's a very stagnant market. It's just like the real estate market. There's nothing going on. People aren't buying or selling. There's just nothing going on, and it's not really a market, right? Because there's just nothing. And the labor market is very much like that. Um, it's slowly degrading,
Degrading, yeah.
degrading. And there's certainly signs. Again, I could whip up 10 graphs from you that would scare you to death, but I could whip up another to tell you everything's just fine. Um, so, again, we talked. Confusion may be the title for this interview, right? It's confusing, just like the real estate market's confusing, and I think investors are comfortable being confused, which is kind of strange, but
Yeah.
that's where we're at.
Okay, so basically, continued to be in a wait and see mode, not changing necessarily strategy, but at least spending some time to identify the exits in case things
Yeah.
break wrong.
Yeah, and what's important, like with labor, the BLS report isn't the only report. There's the ADP report, the JOLTS
Yeah.
report, the the manufacturing surveys, the service sector surveys, what companies are telling us in their earnings reports. So just because the unemployment rate fell from 4.1 to 4 and there were 143,000 new jobs, that's good information, but there's a lot of information to be gleaned, the initial jobless claims data as well. So just make sure if you are going to start worrying about things like the labor market, you don't focus on one number or one set of numbers or what people are telling you about just the BLS data. There's plenty of other data to either confirm what the BLS is saying or go against it.
Well, great point, Michael, and great segue, because I think many folks watching are probably familiar with the HOPE framework that Michael Kantrowitz
Mhm.
has put together, which is sort of the progression for how an economy falls into recession. And really, the key last domino is the employment market.
Right.
And I hear you saying, "Hey, I've got some worries about employment, but you got to look at all the data in that ecosystem." I'll be interviewing Michael. I'll be recording the interview this coming Monday. That interview should release on Tuesday. So, folks, if you're watching this over the weekend, you won't have long to wait to hear from the man himself, who follows employment probably more closely than anybody else I know. So we'll get an update on all the different data sets in the employment space in just a couple of days. All right. So real quick, before we get to bonds, let's make a pit stop here at ETFs. Can you just explain for folks like what has happened to the ETF space recently? Because it seems to become a real source of leverage in the equity markets, where before it was more looked at as kind of like it's sort of like a cheaper mutual fund. Um, and that's good because it helps people get diversification for low cost. But now it actually seems to be sort of fueling the speculative fire of the equity market now, correct?
Yeah, there are all these leveraged ETFs on one security. So you could have a 3 times levered NVIDIA ETF, where all it is it's just going to go up or down 3 times what NVIDIA does. So it's leverage, it's speculative, it's a far cry from the utilities ETF or the S&P 500 or small cap ETF. And I mean, I think like every other market, they have these tendencies to create more speculative ways to transact in them, just like we've seen in cryptocurrency as well. You can do all kinds of things you couldn't do a few years ago. So, unfortunately, I don't think anyone appreciates how much leverage is in the system. And now you tack these on, it just creates there's more pent up leverage volatility. Doesn't mean it's going to explode, but there's a lot of tinder on the ground that can create problems if markets go against, some of these highly levered securities.
So, Michael, I was in a casino a few weeks ago. It's the first time I'd stepped foot in a casino in like, I don't know, a decade or more. And crazy experience. No offense to anybody that likes going to them, but just not my cup of tea. Um, but in there, amongst all the blinking machines and flashing lights and dinging sounds, yeah, there's a ton of ATMs, right? Okay, you finished, you lost it all at the blackjack table. Don't worry, go get some more cash, right?
Right.
Um, Are these leveraged single stock ETFs almost like a payday loan guy setting up a little kiosk next to the ATM? Like, oh, okay, now you've drained your bank account, it's empty. Well, here, take out a payday loan and get back to the crap stable.
Yeah, they're unfortunately levered ETFs in general are difficult. So let's say you buy a levered ETF, it's just let's say 2 to 1, right? And the stock goes up 5%. So it goes from 100 to 105. Your ETF goes to 110. Now let's say the stock goes back down 5%. All of a sudden you're at 99, not 100. The math.
Yeah.
And that's a big problem because over time, there's a slight difference between returns of the underlying and returns of the ETF. When you start using multiples of leverage, that increases rapidly. And, we saw this with, remember, Volmageddon, that the VIX, what was it, VXX, I think it was a double levered volatility short, went out of business
Right.
because volatility went up, what, 50% in a day, which basically made that go down 100% in a day and wiped it out. So it creates more basically, you're just creating more potential volatility in the market, which is all fun and games until it's not. And, we'll see when that day comes.
Okay. So the question I had for you around this, which I think you mostly answered, is this good, bad, or indifferent for the market? And what I hear from you, and correct me if this is wrong, is sort of like, in theory, it's kind of indifferent because it's just a tool and it can be used one way or another. But I think what I'm getting from you is it's kind of a net bad because it's enabling a lot more speculation than is probably healthy for the markets. And if there's a market turn, the carnage it could cause probably is at a scale we probably are going to regret.
Yeah, it's a net bad. I mean, anything you can do to make the capital markets more efficient is good. So, in some respect, having more tools available to make markets more liquid is a good thing. But I think in the longer run, zero day to expiry options, triple levered, quadruple levered ETFs ultimately take away from that liquid. They may be adding liquidity today, but in the long run, they actually hurt liquidity, which hurts the capital markets, which is the foundation for capitalism.
Yeah. Yeah. Okay. All right. Well, that's the world of stocks. Let's now trundle over into the world of bonds. So we got to see each other a few weeks back at the RA event in Houston, Michael, and it was just great to spend time with you in general, as just a person. But obviously, I got to see your latest presentation around bonds, because a lot of people there are invested in bonds, and many of them are invested in bonds through RIA. And people have been watching how bond yields have been rising, and many have scratched their head as those yields has continued to rise as the Fed has been cutting short-term rates. And so you did a good job of walking through, what you thought was going on and why you guys are still, confident in your trade. So I want to give you a chance to give any highlights right now about, whether you want to pull from your presentation or pull new data, but just for folks that are saying, hey, I know RIA has had this long bond trade and we've been waiting for it to play out. Have they changed their strategy? Have they changed their expectations for that trade at all? What's your answer?
No, no. And so I think I had about 30 or so slides in that presentation a few weeks ago. There were two that I really was hoping that everyone that was there understood that, these are ones I focused on because if you want to understand what's going on in the bond market, these are kind of the two graphs, and they're very similar graphs to explain what's going on. So let me kind of lead up to it. Unlike most other assets, bonds, we can do a very good job of putting a value on it. We know about what that yield should be. It's very much a combination of inflation expectations, and economic growth that determines yield. And it all makes sense because it's all circular. Interest rates drive the economy, which drives inflation, which then drives bond yield. So they're all interconnected. And the correlation, we've created a model. Let me share my screen here. Every blue dot on this page is a quarterly instance of this model that we created, which is basically based on inflation and GDP growth and treasury yields at the time. And you can see they follow that dotted blue line. It may be a little hard to see, but they track really closely to it, sometimes a little above, sometimes a little below. The R squared is 0.9692. It's about as good as it gets in especially financial statistics. And at times, these blue dots are above the dotted line, meaning that the yield on a treasury is higher than what that model yield should be. And at times, it's below it. And what we see with the big orange dot is that it's well above it now. And what that's telling us, here's another way to look at the data. The model yield is in orange and the 10-year yield, treasury yield is in blue. Again, you can see how well they track each other. So think of the orange line as that's the value of a 10-year. No one can really pinpoint the exact value, but it's good enough. That's the value of the 10-year. Everything else is market noise. It's sentiment. The bond market calls it the term premium, but it's really just bond investors being risk averse and asking for more yield or chasing yield when it's below it. And then on the right, you can see I just zoomed in on the last, I believe it's 4 quarters. And that gap at the time, this data is a couple weeks old, was 488 for the 10-year yield. And the model said it should be 378. 10-year yield's about 450-ish today. So there's still a wide gap. And the green and red bars show you how big that gap is. And at the time I did this, it was the largest gap since 1990. So what's going on in a nutshell is that bond investors are scared. They're scared that for a lot of reasons, but I think the 2 primary reasons are deficits and inflation. And, as you know, Adam, at that conference, I spoke a lot on both. And yes, both are potential problems, but inflation, let's start with inflation for a couple minutes here. Inflation that we just experienced a few years ago was a function of massive money hitting the market, whether it was pent-up demand, government checks, a whole host of reasons, government stimulus, and no supply. The supply, production was broken, supply lines were broken, more demand, less supply. Your first 10 minutes in Economics 101, they teach you what that's going to do to prices. So there was no real structural rationale for inflation. By structural, I mean long-lasting rationale for why inflation wouldn't be temporary. How long it would last was not known, but we knew that the primary causes were the pandemic and the reaction by both the public and private sector to it. Since then, we've seen inflation come down. We've seen inflation expectations come down. And we can make up stories about why we'll have inflation. We personally think inflation is going to keep coming down. Deficits are the second issue. Everyone likes to say, oh, the government's spending, they're throwing out these numbers in the trillions. What they fail to what you never hear is, yes, government spending was 1.8 trillion last year, but how much did GDP rise? How much did our ability to pay for it rise? So it's all in context. If I took out a loan for $20 million, I'm in big trouble based on my salary. If Bill Gates takes out that same loan, I don't even think he knows he has the loan. He has so much money. So, when you say, oh, it's a $20 million loan, if I tell you I'm taking out a $20 million loan, you guys may have some feelings that it's too much or it's fine. None of you know how much I make or how much wealth I have to be able to really say that it's overwhelming or not overwhelming. And what we have found is debt to GDP rose significantly. I actually have this graph here somewhere. So debt to GDP rose on all the stimulus and GDP fell for that quarter. But then for the last 2 years, it's been relatively stable. So deficits are too much. They're spending too much, and I applaud the efforts to bring the deficits down. I think it's great because these deficits are unproductive and they harm economic growth. But our deficits are not as out of control as we hear these bond vigilantes crying about. And let me just explain bond vigilantes. Those are people that are short bonds trying to make a profit from yields going higher. These aren't do-gooder Robin Hood types that are, rallying, trying to get the government to cut deficits. So, you have a lot of people that are short bonds. I saw actually the short interest in TLT, the bond surrogate, is at a record high right now. So what's going on, going back to our term premium, is that there's fear in the market and that the yields are higher than where they should be. So what we've seen over the last couple of weeks is yields have dropped about 30 basis points or so. And why is that happening? Because Elon Musk and Trump are, I guess, comforting the market that they can reduce deficits. We've had a series of inflation numbers that have been tame. Not great, but tame. They don't show a trend reemerging higher. And that's erasing that term premium. And based on comments from our Treasury Secretary, Scott Bessent, he understands what this term premium is, and he knows he can talk it down. And that's exactly what it seems like him and Trump are trying to do at this point. So, that term premium can erase quickly. That orange line takes a little longer to move because it's based on the economy. Economy just doesn't shift on a dime, but sentiment certainly does, and we see it in all kinds of markets. So the point is that you can almost think of this like a PE of a stock. It was very low. If we say the PE should have been 18 and the PE was 5, it was dirt cheap, the cheapest it's ever been. Now it's working its way back up to 7 or 8. It's still very cheap, but you could still create a lot of volatility as that term premium either erases. We could, for instance, we could rally 70, 80 basis, the yield could drop 70 or 80 basis points purely because sentiment changes, not because inflation or the economy have changed at all. So there's a lot of wiggle room in the bond market right now than is typical. So that kind of helps explain the recent volatility, the spike in rates, the recent decline in rates, and what we should expect. But again,
Okay,
we
so
think the orange line is probably a fair value for yields, but we also think that inflation will continue to decline, and we think economic growth will slow, which should make that orange line decline from here, which will pull the
okay,
blue line down with it.
and that's exactly what I was. Okay, so there's really two components that you think are going to validate your expectations here. One is that this gap between the blue and the orange lines is going to close, and it's going to close by the blue line coming down to meet the orange line, right? Because the blue line is the sentiment extreme right now.
Mhm.
So as that normalizes, they hopefully come back together. So right now you said 10 years trading at 4.5-ish.
Ish. Yeah.
Yeah. And your model says more like 375. So that's 75 basis points right there. But then you say, hey, we also think the orange line is going to go down over time because of slowing economy, et cetera. So there's basically two tailwinds that you expect to be at your back. One is
Exactly.
the slowing economy. The second is the normalizing of this gap, this sort of extreme gap here.
Right. And we can, just real quick, we can look at that a different way. Back to the scatter plot, you can see where we were. It's down slightly from there, but not much. These yellow triangles may be hard to see, but if you can see them, those are the 8 quarters in 2018, 2019. That's pre-pandemic. So you can kind of draw a little box around those and say that yields, if we get back into those economic growth rates and those inflation rates, which we're not really that far from, yield should be somewhere between 3 and, upper 1%. So, that's another kind of guideline to help us think about things. Now, if we go into a recession, all bets are off. They could go much lower. And conversely, if inflation starts picking up for whatever reason, tariffs or, whatever else may happen, the term premium could rise and that the blue line could rise.
Okay, so is it fair to say, go back to that chart for one sec? is it fair to say that in your current strategy where you have, some percent of your exposure to bonds and longer duration bonds, you're playing for this 1 to 3.5% range, where this chart says we should go over time. One, is that correct?
Yeah. I mean,
Okay.
today, I mean,
Yeah. Yeah.
it's an ever-changing forecast, but yes.
Okay. And then you sort of answer the question I was going to ask next, which is, okay, so what do you think could, if you were to be proven wrong, what do you think it is that would prove you wrong? It sounds like, legitimate reasons for inflation to pick back up.
I'm not as worried about inflation. I'm more worried about the term premium that 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 Elon Musk is not able to cut as much and that Trump spends, deficits get back out of control, or the economy slows a little, but then the government starts writing checks to people that create some sort of inflation. Um, so, I'm more worried that the bond market freaks out again, whether it's justified or not justified. Because just because we're at three standard deviations and it's the biggest term premium we've had since at least 1990, doesn't mean it can't become bigger. Just like the stock market, its price to earnings can always go higher than the record, but ultimately it regresses back. That's why you have such a high correlation because it does regress back.
Yeah.
So my number one concern is the term premium and the bond vigilantes. I'm less concerned about GDP growth or inflation at this point.
Oh,
Again, both either can change, but right now.
yeah. Okay. And can you just explain more why? Because there's a fair amount of analysts out there that still think we're in a new, higher baseline inflationary regime, than we've lived in before. And, inflation, maybe the new inflation rate really is 3, it's not 2.
Why is that? I mean, I haven't heard a good explanation why. Really, what it comes down to is have the trends of pre-pandemic changed? So we have a ton of unproductive debt impacting our economy. And that unproductive debt weighs on the economy because it's money that is spent servicing this debt, paying off this debt that could be spent into more productive ventures. So what happened in 2020 and 21? We issued a whole bunch more unproductive debt at a much greater rate. So that helped the economy, created stimulus, it did its job, but now we got even a bigger headwind. The demographic and productivity trends that dictate economic growth rate, that kind of dictate inflation, are still intact from, pre-2020. So it's of our opinion that the trends that existed before the pandemic are coming back. And accordingly, bond yields will start to head down towards those similar bond yield trends. Um, you know, there's other than government actions that are, stupid actions, like some of what they did in 2020, especially 2021, there's no indication that those are happening right now. I mean, deficit fighting is a big thing. I'm not worried about tariffs. Tariffs will be inflationary for some things and disinflationary or deflationary for other things. And, we have experience in 2018 with tariffs. There was actually deflation in Chinese goods because the dollar rose for every single import coming in from China, but only 10 or 15% of the goods were tariffed. And, people substitute goods. They don't necessarily buy the tariff good anymore. They buy something else or they don't buy it. So there's a lot of effects. It's in the aggregate. It's not, well, the price of iPhones are going to double because they're going to tax this chip or this type of screen. You have to look at it in the aggregate. And how does that affect prices of all the other things and the demand curve for everything else? And when you kind of work through all that, it's not clear that tariffs are inflationary and could possibly be disinflationary.
Okay. Well, I wanted to push you on this just because this is one of those times where, um, there's a lack of consensus amongst
And,
smart people about what's happening with
and
inflation.
let me raise one more point, Adam, and this is
Okay.
not going to be popular. When you ask people about inflation, they say it's crazy, right? Because they say, I don't really go shopping much, but they say the price of bread is now $7. I remember in 2019 it was $3, right? That's the way we look at inflation, and we're all guilty of it. And we're always saying, I can't believe we went out to dinner. It was $120. What did we even get? Right? It felt like it used to be 50 or $60 before the pandemic. But the way economists look at inflation is I bought that bread for $7. It was $7.20 a month ago. We have deflation. Prices are coming down. They're looking at the rate of change, whereas we kind of have this abstract view of what it is today and what it was at some other point in time. And both views are correct. They're 100% correct. But let's just say tariffs are put on everything, and everything we import goes up in price by 10%. That's one time. It's not reoccurring. So unfortunately, the prices of all those things go up 10%. And let's just say there's no knock-on effects. But the next month, those prices don't change. They're 0%. So yes, there could be a one-time pickup in the prices of some things, but it's not a rising inflation rate like we saw in 2022, 21, et cetera. And that's
Yeah.
also a big difference. And I know it's not popular. And I know, personally speaking, it's not popular either. I'm going to have to pay more. But if that does happen, it's a one-time thing. And again, but I still contend in aggregate, prices of some things will go up and other things will go down. And net CPI should not really change all that much because of the tariffs. And then factor in the inflation rate, I'm sorry, I'm drawing a complete blank. The currency, the value of the currency. And if the dollar appreciates, you're also making every import, whether it's from China, Canada, Mexico, or Bangladesh, or Japan, or South America, cheaper. So, there's a lot of things that it's easy to say, yeah, the price of chips are going to go up, but no one seems to be able to put it all together and tell you in the aggregate, what does it mean for CPI?
Okay. Well, look, it's a great segue to my next question to you, which is going to be about the dollar. And it's a great clarification versus, the current inflation rate versus the, hey, things are way more expensive than they used to be,
Mhm.
right? They are two different things. I don't think anybody can deny, the latter for sure. All I just want to underscore is that there are smart people on both sides of this
Mhm.
forecasting for inflation. Some that think it's going to be secularly higher and more stubborn. Some who think nope, disinflation, deflation is going to win over. And time will tell. And that's one of the reasons why, Lance, probably is tired of me doing it, but I'm going to ask him every
Well,
week about where we are with bonds. And I will say too, like you guys have Lacey Hunt in your camp. I mean, that's pretty good company to be rubbing shoulders with.
yeah, I actually watched that interview a few days ago, and I was like, wow, that guy's more bullish on bonds than me. So, so thank you for including him in your conference and on your regular podcast.
Oh God, it's a complete honor and pleasure to have Lacey on anytime he's willing to come on. All right, so to the question about the dollar, now the U.S. dollar has gone on a tear in recent months. Um, Tariff trade wars may even strengthen it further. But question for you do you have an expectation about where you think the dollar is going to go for the rest of this year? Or does it look like it's topped out? I have had some conversations on this channel um, relatively recently where people say, the cure for the strong dollar is a strong dollar. At some point it gets too high that it starts breaking things around the world, and then it's got to ease off as a result. Also, too, presumably for a lot of the things that Trump and Besant want to get done, even though they won't say it publicly, a weakening dollar probably would help them. So there might even be some reasons for the current power structure to kind of welcome a weakening dollar.
Although a strengthening dollar, makes imports deflationary, brings down prices of imports. So it kind of works both ways for the administration.
Totally works both ways. Yeah.
The dollar has been stronger recently because of some of the tariff talk, but more importantly, because the US economy has been much more robust than the rest of the world, the developed nations in the rest of the world. They're not in a recession. They're still growing at 5%, but for them, that's pretty poor compared to the double digits they were growing in just a few years ago. Uh,
So, sorry to
Germany,
interject. I would just say there are people like uh, Richard Koo, Nomura's chief economist, that see China as stuck in a pretty awful balance sheet recession. And if you want
exactly.
to hear about that, go watch the interview with Richard. I don't want to derail you with this, but there are some people that would actually say, hey, they actually are in a type of recession. Yeah.
Yeah, I mean, it's a growth recession because their growth rate is still so high. But nonetheless, their GDP is second largest in the world and well above the others that are right behind them. So, you look at Germany, they've been in economic contraction now for almost 2 years. Bank of England today cut rates and lowered their growth forecast to 0.75%. The rest of the world is struggling. So the dollar's doing well. The rest of the world's struggling. They're starting to lower interest rates more aggressively. We're kind of stuck lowering rates. So naturally, the dollar has more value than those other currencies. Now, the problem with this analysis is that if you go back and look at the correlation between the US economy and the world, between the US and the Euro region, the US and Germany and England and all these other countries, they are extremely high. They're kind of like that blue and orange line we showed earlier. They just track each other very closely. There can be
Mhm.
slight deviations, from quarter to quarter, but they track each other. Given the nature of globalization and how far it's progressed over the last, really since World War II, our economy is tied to those other nations and vice versa. So I think our economy will be slowing as this year progresses, catching down to some of those other markets. And with it, the dollar strength should come out. The other important thing is that the dollar is the world's reserve currency. So when Thailand trades with Peru, they're using dollars. They're borrowing in dollars. When their currency depreciates against the dollar and they're borrowing in dollars, that cost of debt increases for them. So as the dollar appreciates, it's reducing liquidity around the world, making their economic problems worse. And that's a big point that people don't consider, that the Fed is really the world's central banker, in part because of the effect they have on the dollar.
Okay. So you wrote a piece recently titled "It's the Dollar Stupid." So, as you look forward to the rest of the year, what role do you see the dollar playing kind of in how you are managing your portfolio?
I think the dollar will slowly weaken. Obviously, with everything Trump's doing and who knows what he will be doing, that could be subject to change like everything else. But I think the dollar will either stick around where it is or weaken on the margin. And that should be good for bonds. So in that article, I I had written a prior article, Why Are Bond Yields Rising? And we talked about the term premium and some of the things we had just discussed. And a reader wrote to me, it's the dollar stupid. And stupid wasn't necessary, but he's right. The dollar is very highly correlated to yields recently. So I talked about why and the linkage between the value of the dollar and the way it's used around the world. But I do think the dollar strength is probably limited at this point, not just for economic and fundamental reasons, but I don't think Trump wants a much. Trump, like every other president, will say they want a strong dollar. Every president, I think, has to say that. They don't necessarily want, sometimes they do. A lot of times they don't want a stronger dollar. So, if Trump is really trying to bring back manufacturing and other jobs to this country, he does want a weaker dollar.
Right, right. So that we can export more to the rest. Our products become cheaper to the rest of the world.
Exactly.
Yeah. All right. Well, I'm looking at the time here. I want to start, beginning to wrap things up. We still have to get to your trades. If we can do lightning round on two topics.
Mhm.
One is uh, just your thoughts so far about the Trump 2.0 administration, and I don't mean politically or on a partisan basis. I just mean I got to look up this this quote because it's now the second time I'm mentioning it, and I think I'm going to murder it again. But I think it's by Yellen, where he says like sometimes there are decades where like not much happens, and then you have years where decades worth of activity happens, right?
Mhm.
This certainly feels like one of those. I mean, I'm just reflecting on this week. I mean, this is a short, very short list of much more things that happened this week. But I mean, we're talking here on Friday. When we, you know, got into the office on Monday, we had 25% tariffs on our two closest trading partners, right? And
Right.
then 10% tariffs on China. Like we thought, okay, we're now fully embroiled in trade wars. That got spun up, spun down. We've had the chainsaw get taken to a lot of the, well, really all the NGOs. I mean, a lot of government funding has been turned off, right? Funding to other countries, funding to all these NGOs. We've been reading about all the things with USAID, and that sounds like I mean, in some ways, sort of a neutron bomb has been exploded in terms of the way in which kind of the DC ecosystem funds itself. Um, we've had the buyout offer of 2 million federal employees. We've had, Trump forced concessions out of Panama, what's going on with the canal down there. Um, I mean, even things like the reversal of men and women's sports. But I mean, it's just been this amazing barrage, and I think it's intentional. I've actually heard some of the strategists on the Trump campaign say we're calling this flooding the zone. Not only do we know what we want to do when we came in, but we want to own the news cycle. In fact, we want to blow up the news cycle so that it doesn't work against us, that just nobody can catch their breath because we just want to keep getting our stuff out there as fast as we can. And so where I'm going with this is um, the question I've asked many people, and I don't know if I've asked you on camera, but it's like if we concede for a moment that Trump is going to be successful with his economic policies, and it's 4 years from now, and he says, "Yep, I got everything done I wanted to get done the way I wanted to get it done," can he do that without the economy and by association the markets taking some pain in the short term because we're ripping off band-aids, we're taking harsh medicine, we're blowing things up before we're rebuilding them. And if you believe that disruption is going to happen, is that priced into the markets right now or not? Because like this
Mm.
list that I just read you of stuff, you wouldn't have believed if I had read it to you the week before.
Right. Right. You know what? I think a lot of it will come down to how sensitive Trump is to the stock market. And what I mean is if he starts doing stuff and the markets just tank, he's going to reverse quickly. And he will be less beholden to do some of the things he may want to do with the rapid fire. And he may hold off and he may try to introduce things that are good for the markets. If he's willing to let the market go for a year, I think he could do some damage to the stock market, but make the country on firmer ground economically down the road. So a lot, I think, depends on Trump and how far he's willing to go. But to your point, valuations are basically record highs almost across every type of valuation technique. And the unknowns have just, multiplied significantly. And every day there's something new. So again, this is why you got to know where the exit door is because there's increasingly instability in what we know, but you're paying a record price to be involved in a market at the same time. And that's not a great combination.
That's a great way to say it. That is a great way to say it. So, okay, so it seems like you share my sort of bewilderment that, the market is able to, again, continue to sort of to shrug off this multiplication of uncertainties.
Yes.
And again, it doesn't mean everything's going to crash tomorrow necessarily, but it just means things are known with less confidence, and you should expect some sort of discount factor for that, which we're currently not getting.
And look, if the PE on the S&P 500 was 6, I'd say who cares what Trump
Yeah, who
does?
cares? Yeah.
It's so cheap, I don't care. But it's the exact opposite.
Yeah, yeah. All right. That is again another great practical thing to point out. So let me ask you this, just purely speculate, won't hold you to it. But if you had to place your bet on which Trump we're going to have in 2025, the guy like in Trump 1.0 who, oh, market's unhappy, I gotta change, I gotta do whatever I can to make the market happy again because that's my scorecard. Or the guy that says, look, I'm playing for legacy. I got to get this stuff done. I'm not going to care what the market does here this year for two reasons. One, I'm playing a longer game. And two, I kind of can blame it all on the previous administration for a good while here. So I may as well, do that while I can.
Right. I think he cares too much about the stock market today. It wouldn't surprise me if he's watching it constantly. And, so I think that will factor into some of the decisions he makes, or at least some of the comments he makes. So I would vote that he does care about the market, maybe more than his legacy, uh, at least for the short run. But, we'll see. Again, it's a very different Trump this time than the last time.
Yep.
He's emboldened to do what he wants to do, and he doesn't have the typical bureaucrats surrounding him like he did. So expect the unexpected.
All right. Well, we'll do that. Okay. So we don't really have time to talk about this. So just a 30-second reaction, if any. If we had had time, I wanted to talk about a recent piece you wrote about meme coins, which was kind of an epic rant of it on its own. Um, Folks should just go read that article if they're interested in Michael's perspective on it. You can go to realinvestmentadvice.com and find it there. But just any top level thing you want to say about what's going on with
It's
meme coins?
I used it as a chance to talk about productivity. Basically, money in meme coins is being sequestered and taken away from the economy where it could do cancer research, where it could be put towards education, innovation, productivity. And it's just one of many, many, many examples of why our productivity growth rate in this country keeps declining because money is put towards completely unproductive purposes.
Okay. So you would call that speculative malinvestment, I would assume.
I mean, there's zero value to meme coins, so it serves no purpose. So it's literally you're just lighting money on fire because it can't be used for anything else.
Okay. For anybody that'd like to push back against that, I'm not giving you the time to kind of flesh out your full thesis there. So again, folks, if you're interested in that, go read the article on realinvestmentadvice.com. Okay, I'm going to try to squeeze in a rant here that I've tried for the past 2 weeks with Lance, and we just kept running out of time. Real quick before I get to it, trades. What trades, if any, have you guys made over the past week?
And I was just looking, our last trade was January 17th. So
Wow.
we did some rebalancing at that time. We got slightly more conservative. We did sell a little bit of Nvidia, Google, uh, and we added a little bit to AMD and Procter Gamble. But again, that was almost 3 weeks ago. And when that deep seek, again, I had a stutter for the seek for six. When deep seek hit the market, one of the things we said is let's just give it a couple days, few days. Let's see how this shakes out. We weren't overly reactive, and that ended up, for the portfolio helping us. Certainly, there were stocks I wish we would have sold immediately, and others we would have bought immediately. But we're concerned about the whole portfolio, not the individual pieces also matter, but it's the total return that really we get comfortable with.
Okay. But it seems like we talked about earlier, you're still very much sort of in a wait and see, right?
As far as DeepSeek goes,
Well, no, I mean in
and
terms of
everything. Yeah.
making market making trading choices. Hey, it's cloudy enough that we feel good with what we have for now, and then as things become clearer, then we'll be able to make more
Yeah.
decisions.
I mean, my guess is we're going to go to a more conservative stance over time. Again, whether that's lesser equity exposure or whether it's exposure in more conservative, lower beta sectors. I don't have those answers today, but that's my guess as far as where we go throughout this year. But you know, there's so much instability in what we know, what we think we know, that it's hard to tell you anything with certainty this moment.
Okay. All right. Well, look, in wrapping up here, the rant that I want to get to here is based on my time very briefly serving jury duty the other week. So as you may remember, Michael, when I saw you, I had to leave the conference quickly to get back to California to report to jury duty. And it was kind of a bipolar experience for me. Like parts of it were just super depressing and frustrating, and I can't believe the system works this way. But then other parts of it were inspiring. Part of it was sort of seeing democracy in action, the judicial system in action, um, and being able to have the opportunity to play a role in that, and knowing that if I were ever in need of uh, the system trying to be fair, make a fair assessment of me, and if I ever got into some sort of legal hot water, that it would, that the system does work. It tries to give everybody a fair shake. It
Right.
might not be perfect in how it executes on it, but that's the intent, right? And I guess a couple things that I took away from that. One is it's super inefficient. So I actually got called to sit on the jury. Like basically, they call a bunch of people to the courthouse. It's about 100 of us, and then they pick 12 people to sit in this jury box, and then they pick 5 alternates. And I was one of the alternates. I was like alternate number 2. And then they kind of begin to give you, they give you just a tiny bit of what the case is about. And then they give you a whole bunch of instructions about how the legal system works and what to expect. But then they really go into like, okay, this is what's going to be asked of you. Do you have any problems with that? Any reasons why you can't serve? Everyone's trying to come up with their excuses to get out of jury duty, right? And then if you're still there, then the lawyers get to start asking you a bunch of questions, right? And so this is a multi-day process. And it's, what, the 17 of us, the 12 in the seats and the 5 in the alternates. And it's still like 85 people in the audience who are watching all this, right? Because we may get sent home and they need to pull somebody up here. So I'm sitting there just thinking like, what is if I add up everybody's hourly wage here, right? Like, what is it costing this county to have all these people sitting here listening to, in most cases, just really mind-numbing stuff, right?
Right.
So like it really is horribly inefficient that way, right? At the same time, you see that this is all done to try to, weed out people who would be bad fits, to make sure everybody understands what's expected of them, and to make sure that when they're ready to get going with the trial, there's enough people there that if you're losing jurors, you're replacing them with somebody who's been keeping tabs of what's going on, all this stuff. And so it does give you kind of the sense of like, all right, well, I mean, I guess if I were sitting there in the defendant's box, I would want the system pulling out all the stops like this to try to give me the fairest shake possible. And again, it's what do you want to call it? Jurisprudence in action, I guess, whatever. It's one of the things that makes America great, right? That you're not just you just don't go to some kangaroo court and some authoritarian judge just bangs the gavel, makes a decision, and then you have to abide by it. So anyways, I found all that stuff really inspiring. And actually, I kind of got to the point where I was like, look, yeah, it's a total inconvenience, but I want to serve. I want to do my civic duty here. I'm happy to be of whatever help I can be. I got dismissed. I was a bad fit, and I can't give a lot of details about the specific case itself, even though I didn't know much, to be honest. But it had to do with a DUI, and when the defendant's lawyers learned that I don't drink, I could tell, you could just see their eyes. That was a big strike against me. And there were some questions about, if a law officer made an observation, would I put greater weight on that than just some regular guy off the street? And I said, yeah, in most cases I would, and it's because their job requires a higher degree of situational awareness, and they've also in many cases given an oath to serve, and so they're supposed to be held to a higher standard. I think on average they do. Now, yeah, some can be corrupt or some can just be wrong, but on average, yeah, I'd trust them. If they were, the example they used was, was it a blue sky or a cloudy sky, right? And I'd probably, if a cop, a pilot, somebody that's their safety and what they do is based upon them actually understanding the environment well is hyper important. Yeah, I'd give that guy a higher claim. Well, they didn't like that either, right?
That's not bad.
Pardon me?
That's not all bad. You got home early.
Yeah, no. And again, there was a little bit of disappointment. I was happy I wasn't going to be stuck there for however long the trial was going to last. But again, I felt a little, sad for missing my opportunity to play a role here. But the other big thing that I mentioned, and then I'll shut up and let you chime in any way, is the really important thing about the judicial system, and I'm going to make an analogy to the market in a second, is it is not about the truth. It is not about the objective truth. And the defense lawyers were real clear about this. The defense lawyer was like, look, he said, I could sit on my hands this whole trial. He's like, I don't have to say anything. I don't have to prove anything to you, the jury. He said, it's all on the prosecution. The presumption of innocence says that my client is innocent unless the prosecutor can convince you beyond a reasonable doubt that he is actually guilty of these charges. And so it's all about what can be proved in court, what you can convince, a reasonable jury is highly likely enough to be true, highly likely enough that you've cleared that reasonable doubt threshold. And that can be really frustrating about the legal system. Like a lot of things that you would just, a reasonable person you would think would kind of take for granted. It's like, no, that's actually got to be proven to be true, versus just taken on face value, right? So that can be super frustrating. And the analogy to markets is you and I can debate all day long with all the data we want about where bond yields should go,
Right.
or what PEs should be in the market or whatnot. End of the day, it doesn't matter. To your point earlier, what matters is sentiment, right? Reality, pure, true risks, all the things that are on the horizon. None of that really matters if the market on net just thinks a different way emotionally, right?
Right.
And so you got to be very, very careful, just as you have to be in a court. You can go in there thinking you've got the slam dunk case, but if you can't actually demonstrably prove everything that you're trying to convince the jury of, you're not going to win. Same thing in the market. If the things that you are hanging your hat on in your portfolio allocation, if they don't prove to change the sentiment that's out there in the market, if you're betting on a turn,
Right.
the market doesn't care.
No, that's absolutely right. And the market will eventually come to reality, but that time maybe 10 years from now, 5 years from now. So, just like the court usually comes to the correct verdict, not always, but I would bet three-quarters of the time. I mean, who knows, right?
Mhm.
But I think it more often than not comes to the right verdict. The market eventually comes to the right verdict too, and prices either surge or they drop like a rock to get back to
Right.
what we call fair value, which is
That
the
that
right
long-term weighing
verdict.
machine, right?
Right.
Yeah.
So, but again, whether that court case is going to be 3 days or 3 years, that's what's hard to tell.
Yeah. Well, all right. Well, look, the last thing about it, and I'd be curious to hear your thoughts on this, Michael, is just more, as I said, I was a little disappointed when I left there. And I talked enough with some of the other jurors there who were, you know, a couple days in, they were kind of invested now in the process. And it really did um, reinforce for me that people want to be a part of something.
Mhm.
That when you're called to, I don't want to say called to greatness, but when you're called to be something that's bigger than yourself, right? That is for a greater good, like justice, right? I think there is something in all of us that really does hunger to be more useful than just who we are in and of ourselves. If we can be part of a greater cause, that's it's part of the human, I don't know, it's sort of the human condition, right? I mean, at the end of the day, we're kind of tribal beings anyways. So things that serve a greater good, I think we're evolutionarily wired to want to be part of that stuff. And I've talked a lot about on this channel, justice, a sense of justice is very hardwired into us, not just as humans, but as mammals. There's a lot of research out there. I've shown the videos of the capuchin monkeys who get grapes versus cucumbers, just to show that in the animal kingdom, lots of different animals have this sense of injustice that if they see, they will act against.
Right.
Um, and it did make me think that, okay, look, as Americans, we're very fortunate to have this system of justice versus many, many other places around the world where billions of people live under regimes that don't have a sense of justice like this. And what's interesting is we're in a new era right now where things are getting heavily disrupted. And look, we just went through an election where, yeah, Trump won the popular vote, but still kind of half and half, right? Pretty divided country on where folks would like to see things go. And I guess what I'm doing here is just trying to give a little bit of a call to action to folks to say we are lucky to have these institutions. And what we should be doing is supporting and participating in the institutions and the institutional trajectories that we want to see more of. So I'm not trying to put a spin on whether what's happening now is good or bad. I'm just saying If you like what's going on, jump on the train. If you don't like what's going on, then get involved, in the causes that are dedicated to trying to create the outcomes that you want to see in the future here. But we are very lucky to have this. We're privileged to live in societies that we live in that have institutions like these. It's up to us to help see that those institutions run the way that we would like them to see.
Yeah, absolutely. I mean, it's a difficult time for a lot of people. And I think other people that, people that support Trump, it's not necessarily easy because he's doing all kinds of things. Some you may have voted for, some you don't like. And, we have to take responsibility for our system. And like you said, get out there and do things and be important, not important, but be useful, be helpful. If nothing else, it'll make you feel better.
Yeah, and we've seen a huge decline in society of people being involved in service organizations.
Right.
Church for sure, but also just the Rotary clubs, the Lions clubs, the community organizations, and I'll even admit to a certain decrease of my time, being out there volunteering and whatnot, because what I've told myself is, hey, look, I've been in the throes of creating a company and then transitioning to a company that I own and run fully. And, the solopreneur life doesn't leave a lot of extra bandwidth cycles and stuff like that. But, there's still time in the day, right?
Mhm.
And that's one of the things that I'm committing to myself for 2025. And this experience, brief experience on jury duty, really sort of, I think, lent some real urgency to a sense of urgency to of like, yeah, when you're out and involved like this, it's for the greater good. It feels good. It's important to do. I'm trying to say, all right, Adam, enough with the excuses. Just find the time, make the time, go get involved. So actually, my wife and I have been talking about, different different things that we want to get involved in. She's talking about, I think she's going to get involved in a hospice service, which, I mean, those people, I talked a year ago when my mother died and went through hospice. That, I mean, people involved in that are complete saints. So I'm very grateful and impressed with her choice there. And I just got to make mine. But again, bringing all this up just to hopefully inspire some folks watching this to say, you know what, maybe I should get off the couch a little bit more and get more involved in some of this stuff as well. Doesn't have to be anything huge. It could be a big brother, spend an hour with a deserving kid, or go clean up some litter, with some community cleanup organization. There's just a zillion things out there that we could all be doing.
Right, right. I agree with you. Actually, a while back, 6, 7 years ago, my brother almost passed away. And I kind of had this moment where I said, I'm going to start doing something good he's alive. He's doing perfectly fine. I'm going to do something good. And on my calendar, it's still on there, and I refuse to take it off. I think it's Friday, pops up in the morning. It says volunteer opportunities. And that's kind of a call to action every week to set something up, to go volunteer. It doesn't mean I listen to it. A lot of times I dismiss it immediately, but every once in a while I'll look at it and say, yeah, I need to do something, and I'll do it. And that little gentle reminder, even if I shrug it off more times than not, is just be thankful for what we have, both personally and it's a great country. No matter what you think of the people that lead this country, it's a great country and it provides tremendous opportunities. But some of that's predicated on us helping other people and making the country as great as it is.
That is exactly what it is. The torch doesn't get passed to the next generation if people aren't in the current
And
generation carrying the
and
torch.
teaching your
Right?
kids, letting your kids, not just telling them to go volunteer, taking them with you, letting them see you waking up at 6 in the morning on a Saturday to go volunteer when they're sleeping. When they see things like that, it means a lot. And
Yeah.
the torch gets passed.
All right. Well, okay. Great points. And so take this conversation as a less than gentle nudge from me, Michael, when that alert pops up on your calendar next time.
Well,
Go
now I
actually go
will.
do it.
Now I
Okay.
will.
All right. Well, look, great conversation, Michael. Folks, if one of the best things you can do for the world is to continue watching Michael and his partner Lance Roberts on this channel week after week, please let them know that by hitting the like button and then hitting the subscribe button below, as well as that little bell icon right next to it. Want to remind everybody, the faculty for Thoughtful Money's upcoming spring online conference literally just gets better and better pretty much by the day. So I think last week with Lance, I announced that Sven Henrik, technical analyst Sven Henrik, had joined the faculty. This week we've announced that Lynn Alden has joined it. She's going to be speaking about how to protect your wealth from purchasing power erosion of fiat currencies. Also by popular demand, we're bringing back Danielle DiMartino Booth, who will be interviewing former FOMC voting member and former FDIC head Tom Hainig. So that's going to be another fantastic conversation about what policies we should be expecting from both the monetary side and the fiscal side in the remainder of 2025. And then we also have several more big names still yet to be announced. So this conference is really exploding to be the absolute must-watch event of the spring. So to go register for the conference, go to thoughtfulmoney.com/conference. We are still offering the early bird discount price. That's the lowest price we're going to be able to offer for the conference. So I want everybody to go now and lock in that lowest price. And a reminder that if you are a premium subscriber to our Substack, you get an additional $50 off of that lowest early bird price with the discount code that I have already emailed out to you all. All right, Michael, you've done a good job, I think, in this conversation as well, sort of talking about the heightened uncertainty that we have this year. I made my diatribe already about folks should just be really honest with themselves about what type of investor they are. Are you a DIY investor who's experienced in the type of environment we have now this year? Are you a DIY investor who maybe needs a little bit of wants to leverage the expertise of somebody who has? Or are you, not a DIY investor and you would much rather recruit a good financial quarterback to come handle all this with you? Folks, whichever you're in, just the honest answer is the right answer. But if you'd like some help, whether it's just advice or whether it's actually working with somebody, feel free, if you don't already have a good financial advisor in place, to schedule a free consultation with one of the ones that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the short form there, and the firms that we endorse will be in touch with you immediately. And as a reminder, these financial consultations are totally free. There's no commitment to work with these firms. It's just a free public service that they offer. All right, Michael. Well, look, my friend, thanks for sitting in for Lance. Thanks for doing your usual exceptional job here. I'm going to get all the emails I normally do saying, oh my God, you should have Michael every week. Forget about that Lance guy. But as we wrap up here, Michael, again, folks who are watching this, we do have some professional investors, but most of them are just regular people just trying to, they're working hard to build wealth for their families. They'd love to prudently grow it. They really don't want to lose it in the event of some sort of big, market surprise. What parting bits of counsel would you have for them here?
Just don't let your gut overwhelm, fear, concern, overwhelm your trading decisions. Give things the 3-day rule, 3-week rule. See how they settle out. Don't immediately trade on information or because you heard me. Don't just buy bonds because you heard me say buy bonds, or don't buy NVIDIA because someone else said buy NVIDIA. Do your research. Don't let these biases that we harbor, these behavioral traits, steer you, because they're going to steer you in the wrong direction. There's a reason Vegas makes a ton of money, and they're preying on your behavioral deficiencies. And I've been in this business 35 years, and I've learned how to offset them to some degree. I'm still very prone to those same traits that a very beginning investor has, but just don't overreact to the markets, because it's going to be a roller coaster of a year. And if you're overreacting, you're going to make the wrong decision over and over again.
I really appreciate you ending with that. One, because I think it's so true, but also it's the main reason why I have Lance and you, on this program every week, is to show people how an experienced professional financial advisor tries to dissociate from, the very real emotions, right, that manipulate all of us, right? And try to make a much more, just sort of a practical, pragmatic, evidence-based decision in your portfolio allocations. And I know that at RIA, you and Lance have given us a peek into your weekly portfolio meetings, right? Where, I know you and Lance both show up with like, hey, here's here's kind of what I think could happen, or here's a big hunch I have, or whatever, right? And then that's got to, that emotion, that thesis has to survive the crucible of the actual meeting where you guys kind of remove all the, all right, well, let's forget about the hype and what you care about
Right.
this, Michael. Let's just like look at the data and the market and let's figure out if this thesis is worth actually trading on, right? And so you try to get all the manipulative risk of the emotions out and just let the thesis or the strength of the argument carry its weight.
Exactly. That sounding board is awesome. And awesome. And also, Lance and I are writing stuff all the time, our daily commentary, our weekly blog articles. That helps further proof to ourselves that what we think is correct or not correct. And it's an incredible tool, and we just put it out there. But you're looking into our brains and trying, you're kind of seeing what we're thinking. And so, take advantage of that. And again, if you have a sounding board, whoever that may be, and things get, pretty anxious and confused and there's a lot going on, use that sounding board. It's worth its weight in gold.
All right. Well, very well said, my friend. Michael, look, thanks again so much for sitting in this week. It's been wonderful. And yeah, let's get you back on sooner next time.
Deal.
All right, everybody else, thanks so much for watching.